Good morning, ladies and gentlemen, and welcome. My name is Cheng Liu, President and CEO of Cathay Bank. Thank you for joining us today. We are pleased to welcome our clients, partners, and friends to this year's Economic Outlooks seminar. In today's environment, economic conditions are being shaped by global events that are complex, fast-moving, and deeply interconnected. Understanding these forces and the potential impact on markets, policy, and business decision-making has never been more important. Recent geopolitical developments have introduced significant uncertainty into the global economy. Tensions in the Middle East have contributed to sharp increases in energy prices, raising concerns about inflation, economic growth, and questions about the future path of U.S. monetary policy. Shifts in U.S. trade policy and an evolving tariff framework are also creating new considerations for businesses as they plan for the second half of the year. Running throughout this backdrop, U.S.-China relations remain a key focus for the global economic outlook. With senior leaders from both countries expected to meet soon, there is growing interest in how this dialogue may influence trade, investment, and broader economic cooperation amid changing geopolitical dynamics. To help us navigate these timely and important topics, please welcome Dr. Jerry Nickelsburg, Director and Senior Economist at the UCLA Anderson Forecast. Dr. Nickelsburg brings expertise and a data-driven approach that helps to put today's economic challenges into perspective. With that, please join me in welcoming Dr. Jerry Nickelsburg.
Thank you, Cheng. And thank you to Cathay Bank, Cheng Liu, for inviting me back to share this time with you and to talk about this uncertain environment. I have a set of slides that I'm going to share right now. And what I want to accomplish here is a broad brush view of what's happening in the U.S. economy, what's happening in the Chinese economy, how those things relate to one another. As Cheng just said, we have a war in the Middle East that just adds uncertainty to what is happening with the U.S. policy with respect to tariffs and immigration. And there's going to be time for questions, and that's when we'll drill down into the things that are at the top of your minds. So prepare your questions and put them in the Q&A, and we will get to them shortly. But let's do this overview, which hopefully will give you an idea of how we at the UCLA Anderson Forecast are trying to navigate this uncertain environment and get some sense as to where the economy is going. Let me begin with our roadmap for today. We're going to talk about the U.S. policy landscape and how that's changed. And it's changed in fairly significant ways, at least with respect to tariffs and with respect to the Iran war since the last time we were together 6 months ago. And then the U.S. outlook and then the China outlook, some summary thoughts, and then we'll get to your questions. So let's begin with the U.S. policy landscape. And we're going to talk first about tariffs. And this is a slide that I showed before, that there are two different kinds of tariffs. The first line is penalty and national security tariffs, and the second is negotiating tariffs. I'm going to do these in reversed order. So negotiating tariffs are what we saw the president impose up until the Supreme Court decision, in which those tariffs were put on for sometimes capricious reasons, that he stated he didn't like how, for example, Brazil was treating the ex-president Bolsonaro, sometimes to try and get trade deals done. Those are all gone. What the Supreme Court said was the president does not have the authority to do that. That is the purview of Congress. The president has, using the Trade Act of 1974, imposed first 10% and then up to 15% blanket tariffs on all imports coming into the United States. But those are limited in time. So on the 24th of July, they go away. And they don't come back unless Congress agrees, which I think we can all agree that Congress is not going to. And so those tariffs go away. So that part of the president's economic policy is gone. That leaves penalty and national security tariffs. Those are Section 232 of the 1962 Tariff Act and Section 301 of the 1974 Trade Act. I think I said Tariff Act, I meant Trade Act. So the penalty tariffs, let's talk about those briefly first. That's Section 301. And the process for imposing a penalty tariff is that a study has to be done to show unfair trade practices. Can be nationwide, usually is specific to a product where it is thought initially to be sold in the US at below cost. First, it goes to something called the International Trade Commission. They deliberate, they make a recommendation. It's not the president's recommendation, it's the ITC's recommendation, and that's a US government organization. That goes to the Department of Commerce for review, study. A new study comes from the Department of Commerce with a recommendation back to the ITC. They deliberate, maybe have another hearing, and then they set the tariffs. So as you can see from that, that's a long, laborious process. And it is one, that is not that easy to impose, and it's country by country or product by product. The second, national security tariffs, that's Section 232. The president can impose that, but you don't impose it and really sort of stretches the imagination that he would impose that in a blanket way. This is aluminum and steel tariffs, and a study is going on now to impose national security tariffs on pharmaceuticals. So those can happen, but as I'm kind of illustrating, the capricious use of tariffs for other reasons as a part of national economic policy is done. It's over with. And so we will see more tariffs. We will know that they're coming. We'll watch the process by which they are coming, and they will be related to specific economic needs rather than being held out there as a carrot for negotiation. And then the economic impacts, we don't have the disruptions from negotiating tariffs. But what we do know is that those tariffs raised prices. We saw that in 2018. We saw it with the 1930 tariffs, and recent studies on goods coming from Brazil and goods coming from India have shown that the tariff has been a tax entirely on the US economy, on US businesses and on US consumers, and has been responsible for an increase in inflation. So what now? Well, with those tariffs coming off, you would expect the inflation rate to go down, except that we now have a new supply shock, which is the Iran war. And this is oil prices. Oil prices have been fluctuating depending on what the market thinks, and the market is clearly very confused about this. Between $85 a barrel and $110 a barrel for West Texas intermediate crude. That's what you see in this graph. That's going to feed through to inflation, first in energy, then it feeds through into other parts of the economy. And our inflation forecast is now we're going to get a new burst of inflation going up to 4%, possibly higher. What you see in this graph is the consumer price index. The solid line is headline, that includes energy and food, and it spikes up there at 4%, a little higher. The dashed line may be a little hard to see, but the dashed line doesn't increase by as much, but it keeps increasing after headline comes down, after energy prices come down, because oil prices feed through to the economy. And, just kind of related to US-China trade, for example, in food, the oil prices feed into fertilizer prices, into diesel fuel for trucking the produce from farms, into diesel fuel for tractors and the like on the farm, into heavy crude for shipping, and all of those raise prices. And so you see the dashed line actually goes above headline as oil price inflation feeds through into the economy, which means that we will have elevated inflation all the way into 2028. And again, in that regard, the cost of shipping goods from China and elsewhere to the US is going to go up because the heavy crude that's used in these ocean-going freighters is now much more expensive. The analysts who study the Gulf and the ability to come back online with the same amount of crude production as before have said that even if things resolve themselves tomorrow, we are many months away from transportation in and out of the Gulf and production by the Gulf states getting back to where it was pre-Iran war. So we have higher inflation coming. That's one thing that's new. Immigration policy, it's pretty much the same as we talked about 6 months ago. There are logistical problems and there are legal challenges, but the Trump administration is increasing the amount of the number of detainees and deportations. There are diminishing returns. That's going to require more funding, and the funding is a little bit in doubt now. The economic impacts that we know from 3 other instances of mass deportations, 1930 to 34, 1950 to 53, and 2008 to 2014, all show that large-scale deportations of those who do not have legal status results in secondary impacts on employment. And you know, the way to think about this is if you think about home building, and a home builder obviously needs drywallers. So if the number of drywallers available to finish off a home goes down, let's say by half, and that would be optimistic given the estimates on the percentage of the skilled drywallers who have legal status, then the home builder can't build as many homes and doesn't need as many other employees. And so that has an impact on employment demand and unemployment. And, you know, one thing that we can see here, one thing that we see as a result of this in terms of labor markets is that supply and demand are barely growing. And what you are seeing here in this is the demand for labor. So this is goods producing, government, which is negative. Goods producing has been negative. We've been losing employment in construction and in manufacturing, and service providing, which has been positive, and much of that has been in healthcare and social services. But when you net those out, we get almost no growth in the demand for labor. And if we add to this the supply, so that's the new right-hand bar, and the orange is foreign-born, the blue is native-born. And what you notice, moving your eyes on the graph from left to right, is that foreign-born, which was fairly substantial in 2023 and through mid-2024, is now negative. And we do have positive native-born just because of growth in the population. But on balance, what we've seen in 2025, and that's these diamonds, what we see in 2025 is labor supply is growing barely, labor demand is growing barely. And so we've got a strange kind of balance or equilibrium in labor markets where we have weak labor markets because of weak demand, but we don't have the unemployment rate going up much, just a few tenths of a percent, as a consequence of the fact that there are fewer people looking for work. So that's our labor market. And let's now look at the US macro outlook. There are a number of things going on that, kind of really stir up the mix here. And one is that we're going to have fiscal stimulus this year. We have the tax cuts and the tax refunds that are going on now. That adds money into consumers' pocketbooks and results in an increase in consumption demand. Consumption demand is 70% of GDP demand. We have new spending provisions from this bill, and that spending again adds stimulus. And the administration has said that they will begin processing refunds for tariffs. Now, that may take a while, but there is a market of those who have claims on the government for refunds to sell those to other parties who will then at some point get those refunds. And so we're going to have additional money that goes into the pockets of entrepreneurs, of businesses, and of individuals that will add to the stimulus in 2026. But we get to 2027 and we don't have any more of those. What we do have are spending cuts that were again in that tax bill in order to make it palatable. And so we have cuts to green subsidies, we have cuts to Medicaid and food stamps and to other programs. And so that's going to turn the fiscal stimulus down to where we don't have much stimulus in 2027. So it's kind of a little bit of a whipsaw there. When we turn to monetary policy, the Federal Reserve cut interest rates by 0.75%, by 75 basis points in 2025, because they viewed this deteriorating labor market that we just talked about. There was also a lot of political pressure to do at least that, if not much more. And we had the federal shutdown, which meant that the Fed was flying a bit blind because they had missing economic data. But what we're faced with today is rising inflation, robust GDP growth. I'm going to see that in a minute, and these frothy financial markets that are trying to figure out what the future might hold. The graph you see here is one that was put together at the forecast. The yellow is hawkish policy, the blue is dovish policy, and this is based on a number of studies, academic studies of what the neutral rate of interest might be in order to balance full employment and 2% inflation. And so the black line that you see there is the Fed's decrease of the federal funds rate, and it's now into dovish policy. So that's also expansionary at this point in time. So we have this year, monetary and fiscal policy is both expansionary, even in the face of increased deportations, soft labor markets, and a war in Iran. And one of the things that is generating robust economic growth on top of the expansionary government policy is AI investment. And AI investment, well, I think you can see here in this graph, let me describe it, that we have the blue bars. And so this is going from 2023, Q1, all the way through the end of 2025. That's the last data we have. So in the blue bars, the dark blue is demand for services. This is by households, and light blue demand for goods, also by households. And as you go across from left to right, that's held up pretty well. Consumption demand certainly has been part of the growth story over the last few years, but if you look all the way over on the right, it's mostly services now, not goods. And so this is contribution to GDP growth. It doesn't mean we're not buying. It doesn't mean that we're not buying goods. It just means that the growth in consumption demand is in services, not goods. Now, if you look at the yellow, dark yellow is high-tech investment. This is where AI lives. Light yellow is other investment, not high-tech. And moving your eyes from left to right, what you see is light yellow, and then the dark yellow starts coming in. And for the last 4 quarters, that is for all of 2025, investment is all dark yellow. It's all high tech. So we have consumers and AI investment driving the US economy right now, potentially fragile depending on what happens with that AI investment. The rates of return on investment are going down, as you would expect, as more and more investment goes into AI. And, kind of when does that turn, or does that keep accelerating? It looks like for 2026, it accelerates. But after that, we have it decelerating in our forecast. And the gray there is demand by government, and that's net negative with the shutdown of a lot of federal expenditures, and also local governments are having a bit of a time with their budgets and are reducing their. Now, tariffs did reduce consumption and investment, but the tariffs are going off, so that should come back, and we should see that this year. But one thing to note is that jobless growth today is not unusual. So when Kevin Warsh was testifying yesterday before Congress, and he talked about AI and high productivity growth, we haven't seen it yet. We have a lot of stories, we have a lot of anecdotes, but what you see in this graph, every dot represents a quarter of GDP growth from 1947 to 2020. And the dark line is trend productivity growth of 1.4%. And so across the horizontal axis, that's payroll employment growth, and the vertical axis is real GDP. And if you divide one by the other, GDP by growth by employment growth, then you get productivity. So for example, if GDP did not grow, but employment didn't grow, then productivity growth would have been zero. Now, what you see here are four larger dots, 2 yellow and 2 blue, and they're right in that cluster. There's no clear outstanding productivity growth. The 2 yellow are subpar. The 2 blue are above average productivity growth, but they all kind of average where we've been historically. So we're not seeing yet that AI is contributing to productivity. What we do see is that we have volatile data, and part of that volatile data is the whipsaw of imports and exports due to tariff policy and now geopolitical events. But that leads us to interest rates. And the Fed has this quandary. Will they lower the rates in 26 and 27? With the nomination of Kevin Warsh, the thought was that he was nominated because the president believed that he would be a strong influence on the Federal Open Market Committee to lower interest rates. He had his hearing yesterday and said, basically, that's not the case. He has been an inflation hawk historically, and he wants to lower the Fed's balance sheet, which also raises interest rates. And he's going into a very different environment. And of course, his nomination doesn't go to the floor of the Senate until the Justice Department's investigation of Jerome Powell is completed. We don't know when that will be. Jerome Powell can stay on the Board of Governors and a voting member of the FOMC through 2028. And the president's personal attacks on him and on the independence of the Federal Reserve, or perceived independence of the perceived attacks on the independence of the Federal Reserve, give him motivation to stay. That means that Kevin Warsh, even when he takes his seat on the Board of Governors and the FOMC, may have a very hard time convincing 12 other members to vote for lowering interest rates, even if he wants them, which is in doubt. And so what we have done is we've pushed interest rate reductions out. We see interest rate reductions in 2027 as the economy weakens, as that federal stimulus goes away, but small interest rate deductions and an increasing slope to the yield curve. That might not happen. The Fed might keep interest rates where they are for some time because we have inflation higher for some time, but it may happen. So that's definitely a source of uncertainty. But the U.S. economy has a lot of inertia that we just talked about. So the yellow here is our forecast. We have a fairly good first quarter here. It's a little over 2%. That's the way we see the data that's come in. The Atlanta Federal Reserve Bank thinks it's going to be just over 1%. So it might be weaker than what we have predicted, but basically a 2% economy. And then in the second quarter, where we are now, ends up being a 1%. Then you get a little growth as we get this stimulus flowing through the U.S. economy in the latter part of this year. Into 2027, for the reasons we've just kind of gone over, we've got a 1.5% economy, sort of a subpar economy. And we have those productivity gains starting to come in into 2028 and the economy growing again, but still it's about a 2% economy. So a lot of inertia, no recession, but not superior economic growth either. That gives us an unemployment forecast going up to 4.6%. And that's due to all of these disruptions, including immigration policy, and then gradually coming down and back to full employment in latter part of 2027 and 2028. Okay, so that is our U.S. outlook. We have inertia from AI investment, a weak dollar. We have some productivity gains built in, and we have upper income consumers who are benefiting from what's happening in equity markets, driving growth in 2026 as they did in 2025. Inflation is going to be higher for longer. Productivity is going to drive growth when we get out into 2028, but the risks abound. So that should be a surprise to no one. Even though tariff policy is not going to be as erratic as it was, what we have experienced thus far in this administration is erratic economic policy, and that is a risk going forward. Will that policy be erratic? A lot maybe depends on the midterms, and it perhaps depends on whether or not the administration has done kind of the things that they thought they needed to do in the first half of this administration, and things are going to settle down in the second half. So that's a big unknown. This kind of goes without saying today. We have geopolitical risk. We don't know what's going to happen in the Middle East. You open the paper each morning, we've got a ceasefire that's on, a ceasefire that's off. Yesterday, Iran seized 2 tankers, so the Straits of Hormuz are not open. China and Europe have a real interest in those straits being open and things returning back to normal. That impacts the U.S. economy as well. We have a risk of an AI investment bust. It doesn't look like it. There's nothing in the data to suggest that, but this has been a very frothy investment sector, and what happens there is, as we go forward, is in question. So something to keep our eyes on. Okay, let's turn to the China macro outlook. The first thing, and kind of importantly, is China relies heavily on imported oil. China, for all of the very amazing success that it's had, is actually resource poor. And when it comes to energy, it imports a lot of what it needs. And half of those oil imports come from the Middle East. So what you see here in this graph is a fairly steep trend from 2009 to 2020. And then there's a little bit of a trend, kind of, as you can see on the right-hand side, sort of flattens out a little bit. It's growing, but not by a lot. What happened there, I think, is important to note. China embarked on a policy of electrification of automobile transport. and is the largest EV market in the world. That reduced the demand for petroleum, and so that, with also the opening of other energy generation plants, has moderated its demand for oil. Still, still half of their imports come from the Middle East, come through the Straits of Hormuz. And so what's happening with the Iran war is really quite important. And the other aspect of that is that because oil exports from Iran have been subject to sanctions, the petroleum purchased by China has come at a discount. And now they're facing much higher rates. The mitigating factor is that the Chinese government planned for this and has substantial supplies of petroleum, which they can release now to mitigate the impact of this. But the longer this goes on, the more impact it will have on the Chinese economy. And this is what fuels export-led growth, which is what has given China its growth kind of throughout and including in 2025. China's trade surplus has widened. What you see here is exports on the top, that's blue, and imports on the bottom. And though China has had kind of a weak domestic economy, and I'll digress on that momentarily, it is, with investment and importantly exports, really fostered growth in the country. And so in spite of the trade war between China and the United States, Chinese exports have grown, and moderately, but they have grown. And with the decline in the value of the renminbi and aggressive exporting, particularly of automobiles, China has been able to sustain export-led growth. But that's not sustainable. China's two large trading partners, the United States and the EU, are both reacting to this and expect the EU to try to reduce imports from China as one moves forward. So the Chinese imbalances, which I want to digress on, are a construction market, particularly in housing, that is dead in the water. There are too many homes and that have been built. So that was a source of growth in the past. And consumer spending. So consumers are spooked by what is happening. And in fact, households are not increasing their demand for GDP. And so all the GDP growth is here and in investment spending. And you can see this in housing. So these two charts, they're kind of little spaghetti charts, hard to read, but let me just kind of generally describe them. This is home prices, and on the left-hand side, we've got home prices by prefecture, and on the right-hand side, we have home prices by city, and they're relative to a starting point, which is why they all start at the same dot there on the left-hand side. And what you see with home prices is that they've fallen like a rock. Now, we had this happen in the U.S. in between 2006 and 2009, and of course that was a big recession. What we're seeing in China is deflation. This is a loss of wealth for Chinese families, and one reason, in addition to uncertainty, that households are not spending and not driving growth. And it appears that this is not going away soon because the Chinese government policy is to not let this market entirely crash and then readjust, but rather to go for gradualism. Gradualism, as I think you know, is a specific Chinese policy that's been followed for years to try and avoid what we see in the U.S. and what we see in Europe, which is deep recessions. And then turning back to exports, This is a real success story for China, and that is exports of cars. And you can see it's just taken off. For Europe and the United States, not so much. And Europe is going to further restrict them. At least that's what's being talked about. But for Canada, for Mexico, for much of the rest of the world, you're seeing very well-priced cars made in China that are being exported. And that's this growth. Now, for many of these countries, you're going to hit a saturation level. So you're not going to see this kind of growth continue. But it is a major success story. And, when you see, for example, this car on the bottom selling for 13,000 US dollars, that's not because of cheap labor in China. When I took a group of UCLA MBA students to China, to Guangzhou, we went to an automobile factory, and there was almost no one working there. It was all robotics. So it's very advanced manufacturing that has driven down the price here. We've talked about China's overinvestment, that it's been relying on investment, and it has fallen. It was 55% of GDP. Now it is 35% of GDP. So it's decreased. And so you see, what China defines as secondary and tertiary industries. And you can see on the right-hand side a decline, but it's sort of flattened out. And it's flattened out because economic policy is such that that China does not want to let this drop too low because of the impact on GDP growth and employment and social stability. So our expectation is this is not going to fall much further in the coming year or two, but that's another imbalance in the Chinese economy. So export-led growth and investment, where in the US and in Europe and in Japan, it is primarily the consumer that is driving the economy. Trade decoupling, we've talked a lot about this in past sessions, and you can see that continues here. So looking on the left-hand side, the EU combined is the largest exporter to the US. And as you can see, that's been growing. And the next is Mexico, and that's been growing. Canada, kind of a little pullback, but China's been declining. And then you see a lot of Southeast Asia in the other ones where you're getting growth. So what's happening is that manufacturing is moving out of China, something that we've known for a long time, and moving into Southeast Asia, to Cambodia, to Vietnam, and U.S. importers are turning to India and other countries in South and Southeast Asia. So this decoupling has continued, and we expect that to continue. But we have a summit coming up, has been scheduled for the 14th and 15th. We'll see if that comes off given geopolitical events. There seems to be an interest to preserve sort of the stability of the current situation in U.S.-China economic relations on both sides. Both are trying to develop independent supply chains. Both need time to get this in place. So our expectation is that this will be cordial. It will result in some transactions taking place, some economic transactions. It's been rumored that there's going to be a fairly large purchase of Boeing airplanes at this summit, and is going to be a reaffirmation of where we are without a lot of change in direction. So in summary, we've got kind of a new world order here. Neo-mercantilism, which we've talked about before, is here to stay. And that's a view that the balance of payments is more important than low prices for consumers. And with the balance of payments, one obtains wealth rather than consumer goods. So tariffs and non-tariff barriers in trade are likely to persist. Again, not the capricious tariffs, but tariffs that will have staying power. And both China and the U.S. economies are evolving in ways that are going to be hard to change, but they're playing for time. We have fundamental change coming, and that comes with transition costs. So that will be a drag on both of the two economies. In the U.S., we've got war, deportations, fiscal stimulus leading to inflation, softer labor markets, and slower growth. Interest rates are not going to decline by much, if at all, but equipment, software, and construction are going to keep the economy out of a recession. And for China, investment, debt, and housing imbalance corrections are coming. We just don't know when, but it could be a few years off. The Chinese consumer is not driving economic growth, and our expectation for 26 and 27 is that they won't. Current export and investment-led growth is not sustainable. And so China's moving into uncharted territory. They have been very successful in navigating it thus far, but it remains to be seen if that continues. We have the 15th five-year plan with promises. And one can be a little skeptical about that. We haven't seen the actual tactics to implement the 15th five-year plan. And it really promises to deliver what the 14th five-year plan promised but did not deliver, which is the pivot that China needs to do to correct these imbalances. So much remains to be seen. And so to conclude, this kind of broad brush overview is lots of risks. There are kind of risks everywhere we turn, but risks also bring opportunities. And so, the risks sometimes make one more conservative in business decisions, but there are opening opportunities as the economy evolves. And hopefully we've illustrated at least some of the places where one should be looking for how the changing economy presents opportunities. And I see two questions here. So let me take those. And so the first one is, knowing the track records of this administration and the incoming new Fed chair, what are your best educated guesses on the Federal Reserve policies, what are expected to change and what are expected not to change, and how they may impact California over the national economy? Okay, so there's a lot to unpack there. As I tried to indicate, I think the president is going to be disappointed with Kevin Warsh. His record is that he's much more concerned about inflation, and even yesterday in his confirmation hearings, he said that, than he is about full employment. As he sits looking at data with the Board of Governors, with the presidents of the Federal Reserve Bank, many of whom have said they see no reason to lower rates. A few have said they do see a reason in the coming 12 months to raise rates. Inflation going up, I think you can expect the Fed to stand pat for the near term. Kevin Warsh will take a lot of heat from the administration on that, but I don't think that's going to make a lot of difference. In fact, he's always been in favor of the independence of the Fed, and it will give him an opportunity to say, skeptics, I really do believe in the independence of the Fed. So that's the expectation. The second part of the question is, what does that mean for California? Well, it means higher borrowing costs for state and local government, to be sure. It means that we're not going to see mortgage rates come down by much, if at all. And so that is a negative on the housing market. And I think those are kind of the direct implications for California vis-a-vis the rest of the nation. With respect to housing, though, housing markets across the country have been in the doldrums. California is not unique in that. So the things that are driving California which are growth in commercial aviation, commercial aircraft production, in space, satellite and launch vehicle production, growth in defense durable goods, and AI and growth in technology. They're not really affected by interest rates very much, some, but not very much. And so California should grow faster than the US. Do you foresee continued weakness in US dollar and increase in gold prices? Gold is a speculative asset, and I'm not going to speculate on this speculative asset. So I'm going to punt on that question. But what about continued weakness in the US dollar? We don't really see that. And the reason is that the world has become much more uncertain. So where are you going to put your money? And if you kind of go around the world, you see, in spite of everything that's been happening in the US, this seems to be the best bet. And that means a demand for US dollars. And so the weakness that we're seeing in the US dollar is really weakness relative to some highs. And we don't see it getting much weaker. Could strengthen, but not a lot weaker. When I saw the comment on opportunities abound, somehow the new prediction market craze came to mind. I'm not really interested in the prediction market as an investment, but how do you think it would affect the capitals and the influence on equity markets? Okay, so when I said opportunities abound, I don't mean it in investments in financial assets, but rather as the world environment changes, there are going to be opportunities for the provision of goods and services that weren't there before. That's just, whenever you have a change in the structural environment of an economy, that happens. And so that's where to look for those opportunities. In financial markets, yeah, that comment doesn't relate to that. Do you believe that Hong Kong's economy and real estate market is in lockstep with that of China? Or do you think there will be mainland Chinese investors going to Hong Kong? So that's a difficult question. I think kind of the second part of that is really what Beijing would like to see happen, that Hong Kong's economy provides for the greater Chinese economy what it did earlier. And I think there's going to be movement in that direction. What's really important to look at as we move through kind of the structural changes that are occurring now is there continued movement from Hong Kong and indeed from Shanghai to Singapore, or has that stopped or even reversed? And that will give you an indication there. Do you see the labor market breaking? And if so, when? I'm not sure what's meant by a labor market breaking. We're going sideways in labor markets. And as we start growing, there'll be an increased demand for labor. The problem that we're going to encounter is that there are industries like food processing, like agriculture, like construction and healthcare that have relied heavily on immigrant labor, whether legal or unauthorized. And so they're going to find an absence of labor, and that's going to increase prices because they're going to have to offer more money for folks to go into those markets. But there's nothing magical about the particular size of the labor market, and nothing magical about whether it grows or not. It's a different management problem, certainly for the Federal Reserve, but I don't really see it breaking in some fundamental sense. Do you see the upcoming US-China dialogue as potential stabilizing force for global trade, or are we entering a more prolonged period of strategic economic decoupling? I would say both. We are entering a prolonged period of decoupling, slower than I think folks were predicting. But I think the objective of this upcoming summit is to provide at least some stable backdrop for all of that to happen. How do you see China-US trade weakening affect California real estate, plus out migration of residents? I think the former has already happened, that we have less demand for California real estate by wealthy Chinese. It's not such a large amount that it's going to result in a significant correction in home prices, but it does moderate the annual increase in prices. And in fact, home prices in California have not increased much in the last year. And I think that is going to continue. The real issue in California is that people aren't buying homes. And so home builders are not building, to any extent greater than what they've been doing. Out-migration actually benefits housing markets in the sense that it puts more units on the market. I'm not sure, what the out-migration is referring to, if it's referring to the billionaires' wealth tax or just the ongoing out-migration of Californians. We're starting to see that moderate. We're starting to see folks moving to California. So, for example, between Austin and the Bay Area, there is net in-migration. And so the difference between cost of living in California and other parts of the country was great enough to induce migration out of California. That difference has been compressed a lot, not because California cost of living has gone down, but because the cost of living in places like Austin and Nashville and Phoenix have gone up. And so we're not expecting this to be a major factor in California's growth or the demand for housing. So how do you see warehouse real estate market in Southern California? This has always been a hot market. The vacancy rates are quite low, but what we are seeing is an increase in the building of warehouses in Kern County, up along the 5, so kind of further out, or in other parts of the state. But the warehouse real estate market thus far seems to be holding up. That's one of the bright spots in commercial real estate, and has been for some time. And I think that brings us to the end. Thank you very much for your attention and your questions.